little bit today about exit planning and some of the things that will follow on to the topic that we discussed last week, succession planning. These ideas share some common roots, but today we want to focus on those things that really mean money in your pocket as a business owner. And the one thing I'd like to focus you on to get us started is that there are things that you can do which will make your business worth more or worth less in the process of exiting. We want to touch on a few of those things today. At Newport, we have a set of ideas we call the 4 M's, which I'll discuss with you, that are drivers of performance and therefore of valuation. It's critical that you make a decision at some point, hopefully earlier rather than later, about choosing an appropriate exit path. When you do that, you're going to have to focus a bit on making sure that your EBITDA, that's a magic phrase that we'll talk about some more, earnings before interest, taxes, depreciation, and amortization, because that's really important to buyers. And it drives valuation. Once you have some idea of what your realistic value is, then you can actually enter into the process of selecting a buyer, and then it's time to pay attention to all the details and the fine print. Let's talk for a minute about those 4 M's and the concept of no man's land. I won't use a lot of time on this, but no man's land is that place that every growing business has to cross. It's not a good thing or a bad thing per se. It happens to all of us, and it's what generally drives you towards a decision of whether to exit, whether to hang on to your company and grow, and just how to do it. This is a central concept in most of the things that we talk about at the Newport Board Group. No man's land is one of those points of inflections in the history of a business that you encounter whether you are successful or not successful. And this diagram is one that we use a lot to show people what happens to typical businesses and why exit strategies may become important to you at various points in your business life cycle. It's a fairly complex and very interesting diagram. I present it to you for your consideration, and I'll be happy to talk to you about it in some detail if you want to later. But what I'd really rather do right now is move on to some other concepts beyond the scope of no man's land. Being able to progress through no man's land shows up in 4 major areas that we call the 4 M's. This is important to you as a business owner who's looking for a possible exit, because these are the 4 areas that most quickly and directly affect your performance. Your performance affects your earnings, and your earnings are going to affect your EBITDA and your valuation. Now, in many cases, privately owned businesses have been maintained for a sustained period of time for the convenience of the owners. Owners have lived well out of them. That's perfectly fine. That's why we have businesses. And then the owner goes to sell the business, and somebody tells him, well, it's worth about half of what you think it's worth. And the owner is shocked. He says, well, why? Is it only worth half of that? Let's talk about that a little bit. Typically, businesses are managed for the convenience of the lifestyle of the owners, are set up to minimize the tax impact of having a lot of money. When you go to sell a company, you want to go the opposite direction. You may have to pay some more taxes, but you want that company to be worth more. And let's talk a little bit about how these 4 areas affect what your company is worth. The 4 M's in our mind, and these are in order of priority from my standpoint: your market, staying in touch with your market, making sure that your operating model continues to produce improving profit margins and will do so as you grow. That's called being scalable. That your management team is the right team for the circumstances, not just the collection of people around you that you put there when you started the business. And finally, that your money is structured properly in terms of amount, maturity, and terms and conditions. So let's spend a few minutes talking about these things in some detail. When I talk to you about your market, I'm saying that there are three elements that you need to consider. Number one, who is your customer? Number two, what offering of yours is it that they want to buy? And number three, how do you deliver it to them? These may seem like perfectly obvious questions and easily answered for a company in the construction business, but let's just take a couple of minutes to think through them in a little more detail, and maybe that will raise some questions that you'll find useful. Who is your customer? Are you selling to commercial builders who are building offices, high-tech facilities, warehouses, residential customers? Each one of those buyers has different things that they value and different things that they want to buy from you, which leads us to the question of what are you offering? What are you offering? What is your product? What are you actually selling? And are you selling what the client really wants to buy? Now, in the construction business, the issue of delivery may be a little bit different. You don't deliver construction results over the internet, but different clients want to have their projects conducted in different ways, and so the delivery issue does become somewhat of a consideration. The point here is to understand your market and to focus your business on satisfying the market. The three key questions are, who's my client, what do they want to buy, and how do I get it to them? Once you understand that, you're going to operate your business along certain principles, which we call the model. Now, this slide is somewhat complex, and it's one of my favorite slides since I sort of came up with this with a friend of mine on a project in the Czech Republic, and there's a lot of good Czech beer behind this model. So the logic is therefore undeniable. I'll be happy to talk with you about some of the details, but the point is we go up here in the top left-hand corner and we start with strategy, and it is what I just talked about, being in touch with your market. Who's your customer? What do they want to buy? How are you going to get to them? And that leads us through a series of other considerations that all culminate in metrics. And these are hard number, measurable qualities of your business. There are operational and predictive metrics. That's like how many units per machine do I produce? What's my my warranty expense or my warranty rate? How fast can I get a building up? What's the quality rating? Those are all sort of operational measures. Those produce financial measures: productivity, profitability, cash flow, balance sheet positions that all impact the evaluative metrics, which are the ones that actually drive the value of your business when you are in a sale or an exit mode. Now, there are interim steps to go through, all of which are key to the successful operation of your company, and none of them operates independently of the ones before it or the ones after it. And that's what maintaining the model and the scalability of the model means. It means integrating these operations so that you produce metrics which end up in a favorable valuation for your exit strategy. We could talk, or rather I could talk for days about this because it's a critical issue. I hope this little presentation here or this slide here raises enough questions in your mind that you'll pursue some of this. Please don't hesitate to call or drop me an email, and I can walk you through this. We can talk about how it affects your business. Once you understand the model and how your model works and how it needs to address the market in a scalable manner, the next question that you need to deal with that is critical in a sales situation is, what does my management team do to improve the valuation and the value of my business? And it's not just, what do they know and what kind of experience do they have? It's how many of them are they? How many do we need to accomplish our key must-do wells? That was the second box in the slide above. How much money can you spend on these people and still create value? What's the mindset necessary from a management team to operate a plan that's leading us to a successful exit? What do they have to be able to do? And what do they need to know? These are not questions lightly asked nor answered. Joe?
One thing I wanted to add here, particularly in construction business, is a lot of times the owner will have relationships that are forged over many years and have become invaluable. So if you're a subcontractor, it's the relationships with the GCs. If you're a GC, it's the relationships with the subs or the building owners or the building property managers. And one of the things that a buyer is going to be very concerned about is, can those relationships be duplicated or passed down either to management, and is your management capable of maintaining those relationships so that you don't lose a considerable portion of your business? And being able to answer that for a buyer is a pretty critical element of the management piece here.
Yeah, when we talk about the process of choosing an exit strategy path for a construction company in particular, this is critical, and I will ask Joe to remind me that we talk about that when I come to the part about choosing a path. Thanks, Joe. Let's talk about money. In an operating situation, one of the biggest issues that most privately owned companies, and especially construction companies, have to deal with is the structure of their money. How much of it do you need to satisfy the demands of growth and operations? How is it structured? You know, you don't need a short-term loan to finance your equipment or to finance your 3-year project. The source of the money and the maturity of the money needs to match the purpose. Costs and terms are critical, especially in a business like yours, where you have a portfolio of projects that varies every day. You may need some money that varies, that floats up and down. You may need some money that's fairly static and stays in the firm for a long time. And you may even need some money to help you finance an exit strategy. So the cost and structure of your money is the fourth M, and the one that may have a disproportionately heavy impact on the valuation of your company when it comes time. Now let's get back to this discussion about choosing the exit path. There aren't all that many options for how you exit from a company. Typically, closely held companies look first of all at transitioning within the family. We talked about that last week. That's a matter of succession planning and has its own set of issues to be managed. Secondly, selling to the employees is often an attractive option. They've been in the business, they like it, they want to be able to take on the role of owners and the benefits that come from that. This can be a very nice, even romantic option, and it could be covered with complexity if you choose to go the route of an employee stock ownership plan, but it can be a very nice exit strategy. The most common one, of course, is sale to an external party, a competitor, a supplier, an equity investor who just wants to own that business. The issue that is typically most stressing for a company in your business, in my experience, has been the reason why folks want to buy construction companies particularly. And as Joe mentioned, it often has to do with relationships that have accumulated over the growth and the life of the company. It may have to do with a particular technology, a particular geographic area coverage, or some other relationship that you may have that somebody else would like to have and is willing to pay money for. And of course, there are going to be some other options, selling to somebody who's accumulating a construction empire, or somebody who's going to want to spread across the rest of the country. These are all issues that need to be considered in some detail. Once again, happy to talk to you, answer any questions you may have.
One thing I would add as well here, Ted, is that when you choose a path of transitioning to employees versus a sale to a third party, one thing that you often do is think about providing equity to those employees before the sale happens. And it's often good to think about that very carefully, because once you start down the path of adding additional owners to the business, if you decide to make a sale to a third party, having multiple minority owners can really complicate the deal. So I just give you that by way of advice to, before you go down one path or the other, make sure you're certain that that's the direction that you want to go, because if you do add additional shareholders, particularly minority shareholders, that could very much complicate a sale to a third party.
And as we said earlier, the item that's going to push your business down one of these paths successfully is, what is your earning capability? How much can you put aside in terms of profits, and what can you generate in terms of cash flow? And that leads us into a discussion of that magic term EBITDA that we mentioned earlier. And my partner Joe is one of the world's leading experts on that topic, so I'd like to turn it over to him to lead you through a discussion of EBITDA.
Well, foremost expert, that's a dangerous thing to say, but thank you, Ted. I'll just put this up here and let you read it for a moment, but I think it's important to know that in valuing a company for sale, EBITDA and a multiple of EBITDA is probably the most commonly used metric. And if you think about how you typically run your business, especially a private business as an owner, it may not be the same way it's going to be run by a buyer. And so you sometimes will try to minimize your EBITDA to improve your tax bill, most notably. That will work against you when it comes time to sell your company. So one of the things we want to talk about is not only what you can do to be thinking about your, what I would call adjusted EBITDA, but also how the buyer is going to be thinking about it. And as my partner Ted likes to say, they will view it through the lens of what they call quality of earnings. And quality of earnings is a global topic to describe, can I repeat and sustain the earnings over a long period? Okay. So if I were a comedian like David Letterman, I would probably do this in reverse order as a top 10 list, but it is a top 10 list nonetheless, and I want to talk through about each of these options so that you think about, when you look at your financials, what a buyer is going to do is come in and say, well, I'm taking that out, I'm taking that out, I'm adding this, I'm reducing that. You might as well be prepared for that in advance so that you know what to look for and what to think about, or if they bring the topic up, you're prepared to deal with it. So the first one is what I use the term non-arm's length revenue or expenses. Typically what this would mean is, let's say you own the building that the business operates out of, and you charge yourself maybe 4 times the market rent for that building, which is great for your, you probably have an LLC set up to own the building. That's great because you earn a lot there, and it increases your expense bill for the construction business, but that reduces your EBITDA, and certainly a buyer is going to look at what would the market rent be that I would be paying for that property in that market. So that's something that you'd want to adjust and line out on your P&L. A second one is revenue or expenses generated by redundant assets. So an example here would be, let's say the owner has a lake cottage and you use that lake cottage to reward employees or have getaways and retreats for management meetings or what have you. The expenses that you use for that lake cottage would probably not be used by a new owner, so you'd want to subtract out those expenses from your P&L. An obvious one is owner salaries and bonuses. A lot of times owners will take a fair amount of cash out of the company, which is perfectly fine and what you should do. It's why you work hard. But a new buyer is going to rationalize those salaries and put them at a level that would be a market rate for someone to come in and act as president of the company, and what they would pay to do that, and you need to adjust for that. We talked about rent above or below market value is specifically related to ownership of buildings and properties that you use and whether or not those rents are at the right price. It doesn't necessarily have to be owned, but generally they're going to adjust it for what could they get in the market at that time for that type of facility or structure. Startup costs. So you want to make sure that your startup costs are removed. So it's basically thinking about any of the one-time items that a buyer would not have to incur to acquire the business from you, and be sure that those are excluded from your P&L. If you have any, and this is not uncommon in our industry, lawsuits, arbitration, insurance claims, one-time disputes, battles between a GC and a sub or vice versa, or an insurance company or what have you, those things you'll want to at least highlight and be able to pull out to reflect a more accurate view of your earnings. One-time professional fees, that's a fairly obvious one, but you will encounter those from time to time depending on the nature of the situation. An IRS audit might require a pretty hefty accounting bill for assistance with that, for example. Another one, if you operate equipment to pay attention to is a lot of times you'll try to move as much of the repairs and maintenance out of capital and into expense. And what that does is helps reduce your tax bill. Well, when it comes time to do calculate your EBITDA, that's working against you as far as valuation goes. So you'd want to try and rationalize, are those expenses really repairs and maintenance, and should they be in capital versus are they actual expenses? And that's one that, depending on how aggressive you are with your accounting, could make a big difference, particularly in a heavy equipment situation. Another one is inventories. A lot of times if you maintain an inventory of parts or materials, a new buyer may not feel as strongly about how valuable they are to the company as you do. So just make sure that you have rational amounts of inventories and account for rational amounts of inventories, because a new buyer is going to definitely mark that down unless it's something that's absolutely necessary for generating income for the business. And then just any other income and or expenses that the new owner would not be incurring. It's really helpful to just run down through your P&L line and make sure you understand, if I were a buyer, what would I care about and what would I no longer want to incur? And I'd ask for you to take that out of your P&L to be sure that we can create a rational valuation based on that.
It's important that we focus on this word rationalize. The buyer is going to look at rationalizing as a way to get the price down to a level that they're comfortable with, where they feel they can produce the right returns and the right metrics. Your position, of course, is to rationalize the numbers in a way that gets you the maximum price that is rational. So it's not a war, it's a negotiation, and everybody's going to try to rationalize everything. Be aware, be prepared, know what you're getting into going in, and you'll probably come out better in the end.
Yep, as much as you understand the tools of their trade, the better you can be prepared to negotiate with them. Great point, Ted, thanks. So I'm sure a lot of you are most concerned about valuations, and so how do we get to a valuation? And there's all kinds of ways. What I've done is I've assembled some data from various studies. A lot of this data here is from a Pepperdine University study on investors, and it covered a broad range of investment types and a broad range of companies. But I thought it would be instructive to share some of this data with you to give you a sense of how professional buyers, because private equity firms particularly are professional buyers and sellers of companies, what are they using and what do they see, what as the study indicates, when you do a poll of private equity firms, what do their responses tell you about the way they think about buying and selling companies? So the first one is the valuation method, and you can see there that there's a lot of different ways. It goes all the way down to gut feel, but the starting point for almost all of these will be EBITDA, and I think that it's maybe the most important thing for you to focus on, both in terms of creating value for the business and also presenting yourself properly to a buyer. one of the things that you might get involved with, depending upon who you sell to, is what are the contingencies of the deal. So will there be an earnout, rollover, seller financing? Oftentimes a seller will carry the note, particularly as it relates to employees acquiring the company. So it's just important to understand that there are a bunch of different ways to think about that. Here are a few, and here's what, as they were polled, by far the most prominent was the contingent earnout. So just be aware that you might be asked to, there might be some form of earnout involved in your deal before it's all said and done.
Just a thought to add to what Joe's talking about in terms of contingencies and how it affects your earnout or your payments. There's also a little issue that comes up in an increasingly common ratio called representations and warranties. And the buyer will ask you to represent or warrant certain facts about your business, which, if they turn out not to be true, can affect the price, the earnout, the contingency issue, and can cost you a lot of money. You may not want to be held accountable for all of those things, so that's a negotiating process, or in many cases you can actually buy representation and warranty insurance, which is not cheap, but is often a very worthwhile investment of some of your proceeds.
Thanks, Ted. So this is probably the one that's going to be most interesting to you, and it's a very busy slide, but I would like to focus your attention on the third column, construction and engineering businesses. And you can see that this is a multiple of EBITDA for the previous 12 months based on the size of the company. So if you're looking at column 3, construction and engineering, which is where most of us are going to be interested, the other ones are nice to know, but this one is particularly useful to us. And then you look down the left-hand side, each row represents a different size of EBITDA. So a $2 million EBITDA company could be worth, on average, through this poll, $9 million. So does that make sense to everyone? Just take the size of your EBITDA, find the range, and multiply it by the multiple, and you have what a general view of the valuation of the company would be. So I think that most people find this very helpful because it's hard to gauge what is the current multiple values in the marketplace. And this is a pretty good poll of, as I said, really professional buyers and sellers of companies. So I've seen ranges higher and lower than this, but this seems to be a very realistic estimate of what you can expect on valuation.
And an interesting takeaway from this conversation for you, when we were talking about improving the caliber or the quality of your company's operations as measured by your profitability, your EBITDA, what this says is the better you get at producing EBITDA, the more your company is worth. This is scalability for the seller. And it makes a very strong argument for improving operations, making your company worth better, and therefore selling it at a higher price on your exit.
Thanks, Ted. So just some additional facts that you might find interesting. I think some may be more or less relevant, but I thought I would share them with you just to get a feel for, again, this is private equity buyers. The percentage of transactions involving strategic buyers, and by that it means someone in your industry or similar who sees the value of your company as additive to theirs, versus a financial buyer, or which I would often say, what I often call financial engineers. So they like to do a lot of financial engineering and aren't as focused on the operating side of things. Interestingly, about 50-50 between strategic and financial buyers. And for private equity, that is not surprising. I would say that for the construction industry, you're probably much more likely to find a strategic buyer than you are a financial buyer based on our experience. But this some interesting facts for you. Premiums paid by strategic buyers relative to financial buyers. So in a lot of cases, the strategic buyer will provide a higher premium, or will provide a premium to the price that you could expect from a financial buyer. But as I said, in most cases, you're going to find strategic buyers anyway. It's not as nearly as likely to find a financial buyer in the construction industry. I want to run through a quick exercise, and it looks really dense and ugly, but it's going to boil down to a point pretty quickly. So if you'll bear with me, selecting a buyer may depend a lot on the offer. So it's not just about the price or the valuation of the business, but also what you might add or remove from that price to figure out how much money is actually going to go in your pocket. So that's what this model is really about, is helping you calculate how much of the offer that's being made to you is actually going to end up in your pocket. And I think it's helpful to go through an example and look at how that would affect the what's called here owner's net proceeds, but to me it's what you put in your pocket at the end. So that's my vernacular for it, I guess. So in our example, there's a couple of different options: selling to employees, selling to management, or a couple of different strategic buyers. And if you look at the valuation and offer price, it range from $8 million to $12 million. It could be an asset purchase or a stock purchase. There could be seller financing or not. And the financial terms are stated in the final row at the bottom. So just a pretty actually representative sample of the kinds of offers that you might have. Well, let's go look and see what happens when you start plugging the numbers in to evaluate that. If you look at the management column, so the third column over, you'll see that the owner's net proceeds is $6.59 million, which is substantially higher than some of the other options that may have had a higher valuation. So it's not just about the valuation, it's about how much money you're going to put in your pocket. And you're all smart enough to do the arithmetic on this. So I just provide this to you as an example of things to consider beyond just the price that you're being offered. The terms and how it's offered can have, and particularly in a case of this kind of sale, the tax bill can have a huge swing on what actually goes in your pocket. So it's I think very analogous to buying a house. A lot of times the purchase price of the house doesn't represent all the other little nuances of the deal that might make it more or less attractive to you. So using this guideline, it should give you some help in determining the final value of what's going in your pocket. And then finally, what I would call the fine print. We don't want to spend a lot of time on this today, but we did spend a fair amount when we were going through our succession planning. Make sure it's well documented. Many a deal has fallen apart or caused a great deal of pain because all of the assumptions and all of the fine points of the deal were not properly papered and documented. And in this case, lawyers and accountants can be expensive, but they're also your best friends when it comes time to protect your interests relative to all the terms and conditions of a deal. The reps and warranties that Ted mentioned earlier is a perfect example of that, making sure that those things are both workable and achievable and don't work against you when it comes to the deal. Particularly if you're involved with a company that has a lot of experience with acquisition, you probably have a sample size of one for sale and buy of a business. They may do it a lot, and they may have a lot of terms that are not as favorable to you. And consulting with your accountant and CPA is a pretty important thing at this step. Ted, is there anything else you wanted to add on that one?
I'd really like to emphasize Joe's point about look for professional help. Unless you're in the business of buying and selling companies, there are so many places to get ambushed here. It really makes sense to have somebody who's been down the path a couple of times before and can help you know which rocks the snakes are hiding under.
Well said. And with that, we'd be happy to entertain any questions that you might have. Here's a little bit of information about our firm. Our firm is focused on helping owners, investors, and board members create value for their companies. And we do it not as financial engineers, but as operators. We're a firm of all partners seasoned with many years of experience in various industries. Ted and I both happen to have some specialty in construction. That's one of the reasons that we're talking to you today. But our firm has over 80 partners across the U.S. And if there's a particular aspect that that you need advice on, we probably have that experience. So enough of the commercial message. That's a little bit about us. And as I said, we're happy to answer any questions that you may have. Now, I have one question that's come via email. So while some others of you may be teeing up your questions, I'll ask this one. It is, how do we find buyers? And I think that's a great question. And there are several options that I can think of. One, and probably the most important, is use your network. So Alliance has a terrific network of customers that they deal with, and they know your industry really well. So one thing, I got to do a little commercial for Alliance Solutions Group, is that they know just about everything about every type of company you could be involved in, and talk to your representatives there, because they will be able to help you. As I said, Newport Board Group, Ted and I have a lot of contacts that might be available to assist as well. So don't hesitate to call on us if you have a particular situation that we can assist with, or put to our network of experts within our firm to try to help you find a prospective buyer. And then the third, there's always the option of investment banking. Investment bankers help companies achieve M&A transactions for a living. They can be expensive, but they can also go a long way to finding a wide range of buyers available to you, and giving you advice on providing a good price. So that's an analysis that you'll have to do. We do not involve ourselves in the transactions directly, but we can advise you on how to maximize the valuation and the performance of your business before you get to that point. Ted, do you have any thoughts on buyers?
Just one issue when you're talking about intermediaries, business brokers, investment bankers. Make sure they're working for you. Aligning interests here is really critical to your success from your viewpoint in executing a transaction. And sometimes a broker or an investment banker will come to you actually representing the seller, in which case their interests are not necessarily going to be aligned with yours. So investment bankers and business brokers are great, some of my best friends, and I wouldn't even mind if my daughter married one, but just make sure that they're working on your behalf and not the seller's behalf.
Okay, well, thanks, Ted. If there are no other questions, I think we'll wrap up the presentation. I would just like to say thank you for your time and attention. We appreciate the opportunity, and we appreciate very much working with Alliance Solutions Group. They've been a great partner with us on some of the firms that we've dealt with, and I strongly recommend that if you have any follow-up on this, please talk to them. I know we'll have a copy of the presentation material available for you to see. And as I said, they can help you get in touch with Ted and I if you have any additional questions or want to follow up on any of these topics. So thank you very much.
It's been a pleasure. Thank you.
Have a great day.